In this video, we are going to see a live example of a long trade performed in the Euro-dollar 5-minute chart. Before we go into the analysis, let's make sure you have the proper chart setups. To identify fractal candles in real time, it is necessary that you use a sensitive setting in the relative strength index. The ideal setting is 4, as you can see in this chart. The first thing we notice in this chart is the upward motion of the market marked from 1 to 6. Notice how price is slowly but surely creating higher highs and higher lows. There is some debate about where the precise points to mark the highs and lows are exactly, which is why these readings can get a little subjective, but for all intents and purposes of this trade, we can agree that it is unquestionable that this market is indeed creating higher highs and higher lows from numbers 1 to 6. Another thing we can notice here is that in each market vector up, the buyers increase their power. Notice the difference in volatility between vector 1 and 2 and the vector 3 and 4. Now look at the difference between vector 3 and 4 and the vector 5 and 6. The market movement between 5 and 6 is interesting to us because it shows an exhaustion movement, which is when price makes a last drive with maximum power, which is what happened in candle 6. Notice also that this candle started with a small gap up, which is another sign that buyers were truly powerful at this point in the chart. Sellers were not even capable of producing small waves in their favor in this area. Take a look at the area where I marked the buyer zone 1. This area comes out of the level in which sellers between 4 and 5 failed to create a lower low than 3. Price peak marked in number 5 is where the buyers picked the control of this market and initiated the vector 5 to 6. We mark this as a significant buyer zone because this was the last place in the chart where significantly powerful buyers showed up. These levels can be useful in the future because of market memory. If buyers showed up vigorously in this level, they might show here again in the near future as long as other contextual elements agree with that premise. After the exhaustion candle marked by the number 6, the market naturally produces a low volatility market that goes in a sideways motion. This is inevitable after a wide candle like candle 6. There was a lot of energy and momentum spent on that candle, so the natural tendency is for the market to pick its energy up again, and it needs a few candles to do that. In the blue arrow down, we can see that the volatility starts to increase for the downside. This makes sense because there is not much buying power up in that level because of that candle 6, so sellers don't have a problem bringing the market down after the blue arrow. This is where the analysis starts to get interesting because now we have sellers going straight against the already proven buyers present in buyer zone 1. Here we have to use our judgment to decide which one of these players is the strongest. The key for deciding which of the market players is stronger in this example is to look at the relative volatility of their movements. Compare the strength of the volatility of the movement between 5 and 6 to the volatility of the movement after the blue arrow down. They are almost the same in terms of magnitude, but the buyers ran the same length in pretty much 3 candles while the sellers needed about 15 candles to bring the market down to buyer zone 1. That's our indication that buyers are still stronger than sellers in this market even though the market seems to be falling down. When price arrives at the black square 1, we begin to see the fractal flow strategy techniques come into play to solidify the context of our trade. Pay close attention to the details here because they are quite subtle if you're not used to the fractal flow method yet. The area inside the black square 1 is what we call divergent price territory because we can see a clear simple reversal divergence happening in the relative strength index, which is highlighted by the sloping red lines. So far there is nothing special about this because it's only a simple reversal divergence. However, notice that I marked 2 vertical gray lines in the chart. The gray line to the right marks a fractal candle, which can only be identified using the gray line to the left. Pay close attention to the precise alignment between the candle tails and the relative strength index peaks in the 2 gray lines. The left gray line aligns precisely with the peak in the relative strength index. However, the right gray line shows a candle which tail goes lower than the previous candle, and yet the relative strength index marked a much higher value. This is what makes the candle marked by the right gray line a fractal candle. We can see that the candle in the right gray line creates a lower low with its tail while the relative strength index creates a higher low relative to the previous candle. This is the idea of momentum offset we saw in the theoretical section of the course. This basically means there is another reversal divergence happening in a lower timeframe. The great thing about the fractal candle is that we can take advantage of the principle of multi-timeframe analysis without actually needing to shift between timeframes, which is rather inconvenient sometimes. Notice also that this small divergence is happening inside the larger divergence that we identified in the chart earlier with the sloping red lines. This is called a second-degree fractal reversal divergence because there are 2 divergences happening one inside another. Remember the concept of fractal, which is when a pattern repeats inside itself. The second-degree fractal reversal divergence is happening in the area that we identified as a major buyer zone. Notice that we have a few contextual elements working together here to create the idea for the long trade you see on the chart. We are not simply trying to trade divergences without understanding what is going on in the markets. The fractal candle inside this whole context is the signal for you to enter the market in the open of the very next candle. I want you to see the candle interpretation of our fractal candle. Notice it has a clear bullish quality, a large body, and small tails. This can be interpreted as certainty of the buyers about their immediate future direction. Very small seller intervention in that candle, which just adds up on our logically consistent context for this trade. However, before considering the entry for a trade, we still need to know if our trade makes sense in the light of the risk management rules and the operational logic guidelines that we established in the theoretical portion of the course. In this trade, you can see that we have a good place to put a stop loss a few pips below the low of the fractal candle. The reason to place a stop loss there is the assumption that the low of the fractal candle is the absolute low of the market vector that started after the blue arrow down. Beyond that, we have the strong buyers in the buyer zone 1 to help preventing our stop loss to be triggered by the sellers or the natural noise of the market. An even better stop loss placement would be a few pips below the low 5. That would represent a double protection because our stop would be below buyer zone 1 and below the undeniable market structure marked in low 5. However, going for this double protection method all the time can be difficult because the size of the stop loss order increases, and then you will need to find a larger take profit order, which will be harder to reach. Speaking of target orders, our target in this trade can be very loose for a very simple reason. If we are correct about our trade context, and the low of the fractal candle is indeed the absolute starting point of the next upward major leg of this market, we have a lot of room to collect profits. In this case, we can simply place a 1-to-3 risk-reward ratio target without any problem. Before we move on to see how the trade ended, I want to grab your attention to something really important here, which is the conflicting nature of the major and minor flows of the market. This is something that you will have to deal with constantly. Notice that our trade is going against the minor and downward flow of the market that started after the blue arrow down. However, by reading the context of the market, we assumed that our fractal candle is pointing to an area where the major flow of buyers will seize the minor flow of sellers, and both flows will ride in synchrony to the upside until the buyer's energy runs out again. Professional trading is all about judging the strength of the major and minor flows, and the precise points where they converge and start to flow together. Notice that if we are correct in our trade context, our fractal candle is giving us pretty good trade location also. Let's see how the market develops. Here we can see that our target is successfully hit. Pay attention to what happened between the opening of our position and the closing of our position. Buyers were obviously stronger, but not too much, so we needed to maintain our orders placed despite the appearance that the trade would go wrong at certain points. As you can see, real-time trading can be counterintuitive sometimes, but we need to stick to our predefined plan. By doing that, we guarantee the integrity of our trading ethic and consistency over the long term.